The silver market is operated on an assumption so deeply embedded, it rarely gets questioned. If you have the cash, someone will sell you the metal. That assumption is now quietly breaking down, and the shift isn't happening on trading screens or in headlines, but at the retail counter, where dealers are beginning to say no unless the order is large enough, and that change carries implications most buyers haven't fully processed yet. At the distribution level, small transactions are often the first pressure point when supply tightens, not the last. Dealers don't announce shortages, they adjust behavior, raise friction, and quietly reprice access. And when minimum purchases jump to levels that exclude casual buyers, it signals stress somewhere upstream that isn't being discussed openly yet. Inside the physical silver pipeline, inventory doesn't disappear evenly. It thins in pockets, stalls in transit, and becomes selectively unavailable long before any official shortage is acknowledged. And when dealers begin clustering orders into higher minimums, it suggests the flow of replaceable stock is no longer reliable enough to support constant small volume turnover. From the outside, a $500 minimum can look like a simple business decision or a temporary policy shift. But inside the market, it functions more like a rationing mechanism, quietly prioritizing certain buyers over others, while masking the underlying constraint that made the policy necessary in the first place. What makes this moment unusual isn't that silver is harder to source, but that the response is happening at the retail edge rather than the wholesale core, implying that pressures are being absorbed and passed down the chain rather than resolved. And that raises a more uncomfortable question about where the real bottleneck is forming. Because when access to physical metal starts narrowing at the smallest entry points, history suggests the issue isn't demand alone, but confidence in replenishment, and that's where the story begins to move away from pricing and toward availability itself. Historically, when dealers alter minimum purchase thresholds, it's rarely about discouraging buyers, and almost always about protecting inventory velocity. The goal isn't to sell less silver, but to slow the drain in a way that keeps shelves from going empty at the wrong moment, and that distinction matters more now than it has in years. At the wholesale layer, physical silver doesn't arrive as a steady stream. It comes in batches, subject to refinery schedules, transportation constraints, and allocation priorities that shift without warning, and when those batches shrink or become less predictable, dealers respond by consolidating demand rather than expanding it. What's happening behind the counter reflects a calculation that small orders create disproportionate strain during tight periods. Processing, hedging, and replacing dozens of small purchases requires the same physical sourcing effort as a few large ones. And when replacement metal isn't guaranteed, efficiency becomes a form of risk management rather than customer service. Reports from multiple regions suggest that some dealers are not only raising minimums, but spacing out shipments, delaying fulfillment, or offering fewer product varieties at once. None of these changes are framed as shortages, yet together they point to a system operating closer to its limits than it's willing to admit. This kind of behavior tends to surface when inventory is technically sufficient but strategically fragile. Metal exists somewhere in the system, but not always where it's needed, and not always in forms that can be moved quickly without cost or compromise. The more subtle signal is that these adjustments are being made preemptively before any visible breakdown. Dealers aren't reacting to empty vaults, they're reacting to uncertainty about the next restock, and that uncertainty is what quietly reshapes access long before prices reflect it. Because once uncertainty replaces predictability in physical supply, the rules of participation change, and the market begins to favor scale over flexibility in ways that most retail buyers don't immediately recognize. Behind closed doors, the conversation around silver supply has shifted from availability to timing. The question is no longer whether metal can be sourced at some price, but how long it will take, and whether that window aligns with the obligations dealers have already made to their customers. In normal conditions, delays are absorbed quietly. Orders roll forward, premiums adjust slightly, and the system smooths itself out. But when lead times become uncertain rather than merely longer, even well-capitalized dealers start altering how they accept demand. One overlooked factor is how much of the retail silver market depends on just-in-time replenishment. Many dealers don't hold deep inventories of every product. They rely on predictable delivery from mints and wholesalers, and when those schedules wobble, the risk shifts downstream almost immediately. Raising minimum purchase amounts reduces transaction noise. Fewer orders mean fewer promises that could become difficult to keep if supply slips further, and that logic explains why these policies often appear suddenly and without explanation, catching smaller buyers off guard. At the same time, larger buyers are quietly becoming more attractive to suppliers. They're easier to allocate, easier to hedge, and easier to justify when inventory must be rationed, and that preference reshapes the market's social hierarchy in ways that aren't obvious until access tightens. What's striking is that none of this requires a dramatic spike in demand. Even steady buying can create strain if the replenishment rhythm breaks, and once timing becomes the dominant risk variable, the entire distribution model starts to tilt. Because when timing replaces price as the main concern, the market enters a different phase, one where policy changes signal more than they explain, and the real stress remains just out of view. At the institutional level, physical silver sits at the intersection of multiple demand streams that don't coordinate with one another. Retail investors, industrial users, and intermediaries all draw from overlapping pools, and when pressure builds in one area, it rarely announces itself to the others in real time. Dealers are often the first to feel that imbalance because they sit downstream of both investment demand and wholesale allocation. They don't see the full picture, but they feel the consequences when expected supply arrives lighter, later, or more restricted than planned. Minimum purchase thresholds become a blunt but effective tool in that environment. They don't solve the supply issue, but they buy time, allowing dealers to stretch inventory across fewer transactions while they reassess how much metal they can realistically commit. What complicates the situation is that these adjustments tend to cluster. One dealer changes policy, another follows, not out of coordination but out of shared exposure to the same upstream constraints, and the result looks like a sudden industry shift when it's actually a delayed reaction. This clustering effect amplifies perception risk. Buyers begin to sense restriction, even if official inventories still exist somewhere in the system, and that perception can alter behavior in ways that further stress the pipeline. Yet the real signal isn't fear or speculation, but caution. Dealers aren't rushing to capitalize on higher demand. They're stepping back, limiting access, and prioritizing stability over volume, which is not how healthy, oversupplied markets usually behave. And once caution replaces confidence at the distribution level, the question shifts from how much silver costs to who gets it first and under what conditions. For years, retail silver demand has been treated as marginal noise compared to industrial consumption and institutional flows. Yet when distribution tightens, it's the retail layer that becomes the early warning system, not because it's dominant, but because it's flexible enough to react first. Dealers operate on thin margins and narrow tolerances. They can't absorb prolonged uncertainty without adjusting terms, and minimum purchase requirements are one of the few levers they can pull quickly without rewriting prices across their entire catalog. What's less visible is how these policies interact with dealer hedging practices. Smaller, fragmented orders complicate risk management when futures liquidity and physical delivery schedules drift out of sync, and consolidating orders reduces exposure during unstable periods. At the same time, product availability often narrows quietly. Certain bars or coins vanish from listings, not because they're gone everywhere, but because sourcing them reliably has become uncertain enough to justify a pause, and that selective absence adds another layer of friction. This environment tends to disadvantage newcomers and casual buyers first. Access becomes conditional, not on intent, but on scale, and that shift subtly redefines who the market is designed to serve during periods of strain. The irony is that these changes can occur without any dramatic price movement. The screen may look calm while the physical side is being restructured behind the scenes, and that divergence is rarely sustainable for long. Because when access tightens without price signaling, pressure builds quietly, and markets have a history of resolving that tension in ways few participants anticipate. Historically, this kind of quiet restructuring doesn't stay confined to retail policy for long. It migrates. What begins as a minimum purchase adjustment can evolve into longer delivery windows, selective fulfillment, or stricter payment terms, each change subtle on its own, but cumulative in effect. The deeper issue is confidence and continuity. Dealers can manage tight supply if they trust the system to normalize, but when signals become mixed and timelines blur, precaution starts to override growth. That's when access rules harden rather than relax. In these phases, communication often goes silent. Suppliers avoid firm commitments, dealers avoid explanations, and buyers are left interpreting behavior rather than statements. The absence of clarity becomes its own data point, one that suggests internal uncertainty rather than external shock. What makes silver particularly sensitive is its dual role. It isn't purely an investment asset, and it isn't purely an industrial input, and that overlap means stress can emerge without a single obvious trigger. Small disruptions across several channels can accumulate unnoticed until distribution begins to narrow. Dealers understand this intuitively. They may not have full visibility into global flows, but they know when buffers are thinning and when replacing metal feels less routine than it should, even if nothing has formally broken yet. That's why minimum thresholds matter more than they appear to. They're not a response to panic. They're a hedge against ambiguity, and ambiguity is often the most underestimated risk in physical markets. Because once ambiguity becomes persistent, the system doesn't snap. It constricts, and the next stage tends to arrive quietly, just as this one did. At this stage, the silver market isn't broadcasting stress through price spikes or public warnings. It's signaling through behavior, and behavior is often the last place casual observers look. Policy changes, access limits, and procedural friction rarely make headlines, yet they're how physical markets adapt under pressure. Minimum purchase requirements serve another, less discussed function. They screen buyers, not intentionally, but effectively. Those able to commit larger sums move to the front of the line, while smaller participants are asked to wait or scale up, reshaping demand without ever touching the price mechanism. This dynamic tends to reinforce itself. As access becomes conditional, remaining buyers adjust expectations, orders consolidate further, and the market begins to operate in larger blocks, even if total demand hasn't meaningfully changed. What's notable is how quickly normal assumptions erode. The idea that physical silver is always available in any quantity, at any time, quietly gives way to a more conditional reality, where availability depends on timing, scale, and supplier confidence. None of this implies an imminent breakdown. It implies a system reallocating risk in advance, pushing it outward and downward rather than absorbing it centrally. And that choice has consequences for how future stress will surface. When markets do this, they're not predicting an outcome. They're preparing for variability, and preparation often reveals more than forecasts ever do. Because once preparation becomes widespread, the conditions that made it necessary are usually already deeper than they appear. For decades, physical silver has been treated as a product you access on demand, not on terms. What's changing now is subtle but significant. Access is becoming negotiated rather than assumed, and that shift rarely happens without deeper forces at work. Minimum purchase requirements are one of the least disruptive ways to recalibrate participation. They don't alarm markets, they don't invite scrutiny, and they don't require explanation, yet they quietly redefine who can act and when. The absence of transparency isn't accidental. In physical markets, signaling too clearly can accelerate the very behavior dealers are trying to manage. So adjustments are made indirectly through policy and process, allowing the system to slow itself without drawing attention. What remains unresolved is how long this posture can hold. If supply normalizes, these barriers will fade as quietly as they appeared. If it doesn't, the next adaptations won't look the same, and they won't be as easy to ignore. History suggests that when access tightens before price responds, the eventual reconciliation tends to be abrupt rather than gradual, though the timing is rarely predictable and the trigger is often external. And that's why the current moment matters, not because of what's visible, but because of what's being constrained just below the surface, waiting to either release or compress further. For decades, markets have taught participants to watch prices for truth. Yet the physical silver market is reminding those paying attention that behavior often speaks first. Minimum purchase requirements aren't a headline event, but they are a boundary, quietly drawn, that reveals how confidence is being rationed alongside metal. What's unfolding isn't a crisis narrative, it's a procedural one. Access is being shaped, flows are being managed, and risk is being redistributed without announcement, suggesting a system adapting before it's forced to react. The critical takeaway isn't that silver is unavailable, but that availability is becoming conditional, and conditions have a way of tightening faster than expectations adjust. When markets shift this way, the early signals are rarely dramatic, but they tend to be consistent. Whether this phase resolves through normalization or escalates into something more restrictive will depend on factors still moving beneath the surface, largely out of view. Dealers will continue to adjust quietly, buyers will adapt unevenly, and the market will reveal its next chapter through actions rather than words. Because in physical markets, the most important changes rarely arrive with warnings, and by the time they're widely acknowledged, the rules have already changed.